Good morning. It's true that I've got a heavy slide deck, but don't worry, I won't go into each detail. The slides are in your pack, actually. Just a word about EuroSIF. Some of you may not be familiar with who we are. We are the Pan-European Sustainable Investment Forum, representing the sustainable and responsible investment industry. That means a range of asset managers, non-financial rating companies, sustainable index providers, and so forth and so on, managing a total of over 1 trillion euros in assets. So I will come to this debate about long-term investing with a very specific angle, very different from my colleagues at the panel, as you can expect from a sustainability-oriented organization. To start with, I have a few facts and figures. Some of them may be very well known to some of you. LTI is, there's no single definition of LTI, in fact. You know, many organizations would have different definitions. But what you can find in the literature is that there's a common agreement about the expected objectives of long-term investments. One is about promoting financial stability. One is promoting growth, employment, that's been mentioned before by some other speakers. These are high-level policy goals. Another one we would like to stress, of course, at EuroSIF, is that there is also, through LTI, an opportunity to support the transition to a more sustainable Europe. And I shall remember here the objectives of the Agenda 2020. And we would argue at EuroSIF that all these objectives should actually not be decoupled when one thinks about long-term investments. Fact number two, you know, there's no such thing as institutional investors. In fact, there's a range of different animals within that bucket, that terminology. As you can see, insurance companies, pension funds represent the bulk of the European investable assets within that segment. By the way, they are both liability-driven investors, and we shall come back to that. Another very large category of investors, no surprise, would be the asset managers, you know, distributing their retail mutual funds. And these are the animals I will focus on in my speech. The reason is also because, in particular, insurance companies, when they invest their own reserves, for example, as well as pension funds, in my mind, sit at the top of the food chain. In many ways, the impulse, the shape of long-term investments, they dictate through the investment management agreement what an asset manager shall or shall not do. So they have a huge responsibility in supporting the growth of long-term investments by definition. Long-term investment is a difficult term to define, as I said. Usually, you know, one would approach long-term investments by defining them through, you know, a range of characteristics such as liquidity characteristics, basically using an asset class-oriented definition. And while it is true that some asset classes are more prone than others to long-term investments, we would argue, and we're not the only ones to do that, we would argue that some asset classes actually can play both a role in short-term, but also in long-term investments, typically, of course, public equity and public debt. And I'll make that comment, that's very important, because I will broaden, you know, that's very different, of course, with what's been said before. I don't come especially from an infrastructure or real asset perspective, but a broader one, but a very important one, I believe. When you look at what insurers, you know, being the key institutional investors hold in their assets, in their portfolios, you see, and that's no surprise, that the bulk of their assets is invested in fixed income, you know, for about 75% of their portfolios. These are numbers from Insurance Europe, by the way, pretty fresh numbers. That represents about 5 trillion in euros, pretty significant amount. You know, I won't expand on that, but you can see that the alternative bucket, where real assets, where infrastructure assets would sit, is typically much smaller there. So for us, that's why I'd like to broaden the discussion to the role of public equities and public debt fixed income, you know, when we think about long-term investments. The same comment is also valid for pension funds, by the way. Again, all the details in your pack. Now, a word about regulation, and I'm by no means an expert on Solvency II, but there is a growing body of academic and non-academic literature that shows that Solvency II may have an impact on the asset allocation of pension funds and insurance companies by definition. What you have here is the financial return, or the risk-adjusted financial return from different asset classes and on the required capital under the Solvency II regime. And what it shows, without entering in the details, is that the attractiveness of investing in equity or even private equity is much lower than investment in actually shorter-term bonds. Even long-term bonds under that scenario might suffer from a decrease in many ways. So under Solvency II, clearly, life insurers, pension funds will have to revisit their asset allocations, in particular their strategic asset allocations, and we all know for a fact that strategic asset allocation is what delivers financial return, financial value over the long term. So to conclude this first part about the facts, a couple of recap. Institutional investors, we're mainly talking here about pension funds insurers. We believe at Eurosif that LTI is something that goes beyond a pure discussion around illiquid asset classes. It should be broadened to also listed equities and secondary liquid market there. Regulation definitely has an impact on the long-term investment and asset allocation strategies of institutional investors. And capital market, we believe, should play a critical role as well in being channeled to support long-term investments. Now, what are the issues with capital markets? That's why I broadened a little bit the discussion. The fact is that capital markets seems to be more and more short-term oriented. You've got here a chart showing the average holding periods on a number of stock exchanges, including a lot of European stock exchanges. In fact, Andy Alden from the Bank of England a few years ago did a study showing that the average equity holding in the UK equity market was about 7.5 months. In fact, other studies show that it's only a couple of months. And of course, these averages are biased by the effect of high-frequency trading and some of the shorter-term oriented hedge funds. But also, we argue that institutional investors, being a large provider of funds through capital markets, also play a role there. And the point is on this slide that you've got here a sample of actively managed institutional equity portfolios against a range of benchmarks, including some European or European ex-UK benchmarks. And what that shows is that the turnover within those portfolios, those mandates, is actually pretty high. In average, it's about 72%. Of churn, basically, of securities within these portfolios. In some instances as well, this turnover has increased over the past years. So there's clearly a kind of a question mark over the long-termism of capital markets and institutional investors in those markets. Why is that? We believe there are a number of flows that play against the long-term orientation of institutional investors. First, the question of a mandate duration. For a large part, mandates are for 3 years. Sometimes 5 years, but it is very common to find mandates with a duration of 3 years. It's clearly not a very long-term horizon. There's an obsession of benchmarks. In overall, a general comment about the way performance of a given asset managers is measured by those providing mandates, so pension fund insurers. There's an obsession for short-term performance. It's not very rare to find pension trustees assessing the performance of their asset managers on a quarterly basis even. So this creates also a bias towards short-term investment. We believe also that there is a narrow interpretation of risk management, in particular to the extent it does not include, in most of the cases, the so-called ESG criteria, or non-financial factors, ESG standing for environmental, social, and governance factors, and I'll come back to that. There's also a big role to play by incentives, with the very fact that performance is measured sometime in a short-term time frame is a problem. And also the impulse, the kind of mandate that is given to asset managers by pension funds and insurers is also a problem. And the consultant also have a role to play there. So this complete these challenges raised by some of the prudential regulations. Coming to risks, this, by the way, just to show that I'm not talking in the void. If you look at the global risk report from World Economic Forums, they highlight a number of risks every year. And if you take the top quadrant on the right side, the top risks, basically, 5 out of the 8 top-ranked risks are basically related to environment and social issues, such as climate change adaptation, greenhouse gas emissions, water shortage, food shortage, etc. So this is not the dreamer vision, if you will. This is really becoming very material to investors. Another point about this, and just focusing for a minute on climate change, you probably heard about this. This is an NGO called Carbon Tracker, and they published a report on stranded assets. Basically, they think that if policymakers enforce the 2 degrees limit cap on the rise of temperature, 80% of the current fossil fuels reserves, coal, oil, gas, will become stranded, okay? People won't be able to use those reserves. What that means is that stock exchanges that are dependent on oil, gas, coal companies will have a problem. As a matter of fact, stock exchanges are exposed to that risk. For example, you take the London Stock Exchange, about 20 to 30% of the capitalization is connected to fossil fuels. So there is therefore a real material risk, long-term risk for investors if they don't take into account that, those non-financial issues, this exposure to climate and other resource limitation. Am I a dreamer? Well, not really. The press has taken it. The UK Institute of Actuaries, and they are not, a bunch of activist NGOs there. The UK Institute of Actuaries published a few months ago a study that says, I quote, that the UK defined benefit pension schemes could become insolvent in no less than 35 years, just because of a resource constraint we face. And so forth and so on. So basically, investors do have to start realizing that ESG factors do play a role when you think about long-term investment. And I quote the chair of the European Fund and Asset Management Association, who again is a mainstream association. They are not like Eurosif focusing on sustainability. And you can see what he says, to be a long-term investor without integrating ESG criteria will actually be contrary. Sure, it's not easy, there are challenges, but it's something that is becoming increasingly material. So what could policymakers do? I hope you're following me there. I can see you nodding. Well, there is no silver bullet. As Tim said, there's no silver bullet around long-term investments. A range of things to tackle. And I just opt to focus on what we're pushing for at Eurosif, basically ESG integration in investment policy, investment practices, and disclosure. A couple of ideas. First, make sure that long-term investments are not decoupled, as I said, as a preamble, from Europe environmental and social ambitions. This should be definitely one of the explicit goals of long-term investment and any measure to foster long-term investments. We believe also that for a start, we need to encourage companies to disclose their CSR performance, how they take into account the non-financial factors that may have an impact on their financial performance. And I refer here on the current proposal from the Commission that is currently being discussed with the Parliament and the Council. Because this is raw material for investors that they need to have in mind when they assess, when they evaluate basically a company over the long term, as these factors may become material over the long term. We should also encourage ESG disclosure by asset owners, asset managers as well, but in particular asset managers. And so they should disclose in their statement on the investment principles to what extent they take into account those ESG criteria. In fact, there have been some studies showing that it's absolutely not contradictory with your fiduciary duty. On the contrary, if you're a good fiduciary, you should take into account ESG factors over the long term. We believe also that there's a role to play for active ownership as a means to engage a constructive dialogue with your company to be more, and we've recently published a study on this showing that there are also positive externalities for the economy as a whole. And this is also coupled with a longer term approach to investment. And finally, we think that policymakers should support the development of long-term savings market as a way to encourage innovation by asset managers to develop more long-term oriented savings vehicle.